If you're looking to purchase a home and using an FHA home loan, here are the 5 deal killers that you want to be aware of as you move through the process. First and foremost, pay attention to how long the seller has owned the property, because FHA has a 90-day property flipping rule. That means if the seller acquired that property in the previous 90 days from the date you go under contract, then you cannot use an FHA loan to purchase that house. Now, there's ways through that, and generally it's waiting until the 91st day of when the seller acquired the property. But there are also a few different exceptions that could be applicable. But for the most part, those exceptions are if their property was a foreclosure, maybe HUD took the property back, or there's another government entity that owns the property. Generally, that is what covers the exception modeling. Also, if it's an inheritance, there could be an exception for that. But just straight up, maybe you have an investor out there that acquired the property. Maybe they did a little bit of work on it, and now they are selling the property in the open market. You come along, you're using an FHA loan. Important to pay attention to how long the seller has owned the property. Now, generally, your real estate agent is going to be aware of this, but there are situations where it just gets missed. And we actually have a client right now who is purchasing a house. They'd already been pre-qualified with another lender. That lender declined their home loan. They came to us. We were able to figure out a strategy. But most importantly, they've already been under contract for 2 weeks. And that lender did not find out or see or pay attention to the fact that the seller just bought the property, which means that that buyer, an FHA buyer, cannot purchase the property for 91 days. So the time that the seller owns the property is one of the big things to know when you as a buyer are using an FHA loan. They call that the 90-day property flipping rule. Okay. Number 2, federal debt. If you have federal debt lingering out there, and federal debt could be, maybe you had a student loan that you have defaulted on. Federally backed student loans will show up as a federal debt obligation. So if you're using an FHA loan, which is a government-backed home loan, they care. They care about any other federal debt that you've defaulted on. Other examples would be IRS delinquency on taxes. That could be a red flag and a deal killer if you're using an FHA loan. And also just foreclosures in general. If you had a government-backed mortgage, maybe on a previous property that you owned, and that property went into foreclosure, you could have some government debt out there. And so from a lending standpoint, here's what happens. If you're using an FHA or a VA or a USDA home loan, the lender is going to check to see if you have, they're going to check CAVERS, which is kind of like a government auditing system, a government warehouse, if you will, of all federal debt related to you. So if there's other things coming up in that CAVERS check, which is part of the home loan process from a lender standpoint, then that could be problematic and could be a deal killer if you're using an FHA or other government-backed loan. All right, number 3, the condition of the home. This is very specific to FHA, and VA has some nuances as well, but today we're going to talk FHA. And with FHA, things like if there's chipped paint on, let's say, anywhere on the house, and maybe it's chipped paint on the back patio, it's very likely that the appraiser is going to call out that chipped paint be sanded, scraped, sanded, and then repainted, and then a reinspection would have to be done. So in that scenario, it doesn't mean you can't get an FHA loan. It just means that appraisal is going to be subject to a condition in order to get the FHA loan. So the property is really important in the condition of the property. Move-in ready properties are really the creme de la creme when it comes to FHA. If there are broken windows, if there is like an active plumbing leak, obviously we talked about chipped paint. If the appraiser, now appraisers don't go on the roof. This is something that a lot of people don't know. Most appraisers, the appraisal process, when they're standing on ground and they look up at the roof line, if they happen to see anything concerning just from that view, no, they're not crawling up there and looking at the roof. No, they're not doing a roof certification as part of a traditional home loan and appraisal. But if they see the roof line and they have concerns, they may make that appraisal subject to a roof certification. So again, just like another layer, FHA is very focused on ensuring that the consumer is protected during this process. So that means if you are using an FHA loan, I think sometimes buyers get frustrated with the lenders. Like, why is that? Well, why is that? Because FHA wants to protect you. And so just know that there are conditions of a house that may not be eligible for FHA. Now, your lender is going to be able to walk you through those and very likely come up with solutions depending on the seller and what needs to be done. All right. Number 4, large deposits. Okay. Do you want the truth? Probably the most painful part of the home lending process is documenting assets. And those are assets for funds to close together with closing costs, down payment, but it's also just deposits that are working through your everyday bank account. So for example, the general rule of thumb for FHA is that a lender is going to need to source and document any deposits that they see on the bank statements. Generally, that's 30 to 60 days of bank statements. If they see a large deposit that exceeds 50% of your income, then they would call for documentation. Well, if your friend has loaned you the money to purchase the house and you deposit the cash, that's not going to be an acceptable source of funds for FHA. So this could kill the deal. Very important to know the rules around deposit verification, cash. Everyone thinks that cash is king, and it is in many scenarios, but not when it comes to home lending. Because from a lending standpoint, the home loan guidelines require lenders document all deposits that are coming into the assets that we're using for the home loan approval. So deposits are important. Also, kind of think about it. There may be a case, even if the deposit is less than 50% of your income, but maybe it shows a deposit right around the time that your earnest money was coming out. So let's think through. Once you go under contract, you have an executed purchase contract. The seller agrees, you agree. The purchase contract is fully executed. That usually goes to the lender and the title company. At that point, once it goes to the lender, and to the title company, you're generally being asked by your real estate agent to produce earnest money. And earnest money are good faith funds. So it's money that you would give to the title company. They would hold it in escrow. It's kind of like a little holding account. And those funds have to be documented. And those funds get credited towards your final closing cost and down payment. So know that's important to know. But if that earnest money on your bank statement, like let's say that your earnest money comes out of your bank statement December 15th, but on December 14th, there's a large deposit. Maybe it doesn't exceed 50% of your income, but there's a large deposit that is unidentifiable. The lender could, in that situation, call for that to be documented. So just know documentation of funds is a big deal, not just with FHA, but specifically, and in this scenario, it's important to know it could kill the FHA deal. All right. And then number 5, dwelling type. Dwelling type, so important. FHA, when it comes to condominiums, has a completely different approach. And that approach is, first of all, you'll want to have your agent, or you can do this. It's a public domain. You can go to the FHA condo lookup link and you can enter the name of the condominium and see if that condominium is approved by FHA. If it is, great. That is step 1. That doesn't mean that you're like smooth sailing from there. It just means that the lender now says, great, this condominium is approved. The borrower is likely eligible for FHA financing, but the next step is the lender is going to go through the HOA condo approval certification to ensure that the condo project still meets the lending guidelines. And that generally will happen within the first week or 2 once the lender receives the purchase contract. If the condo is not on FHA's approval list, it doesn't mean that it's a done deal and you can't acquire the property. It means, though, that FHA will allow lenders to utilize their single unit approval process. And all that means is that the lender now has to reach out to the HOA, has to have the condo certification form completed. Generally, there's a fee to do this. So if the lender's asking you to pay for that, then no, that's why HOAs charge for this. Once the lender receives the information, then they're going to review it and to ensure that it meets FHA loan guidelines. If it doesn't, then you would not be able to use FHA financing on that particular condo. So I know this is a lot, right? But just know if you are in the market and you think FHA is a good home loan program for you, and it's a great program, it's been around since the 1930s, it's backed by the federal government, there's some great things about it. If you're interested in learning more about FHA, don't hesitate to reach out. 480-725-0150. The Kelly Zitlow Group is here, and we love to have these conversations and just chat casually about what it is that you're looking for and determine if FHA is the right financing scope for you. We'll talk soon.